ECB's Christine Lagarde pushes EU lawmakers to pass legislation for a digital euro launch. Trump says U.S. interest rates should be at least 2 to 3 points lower. And Morocco's central bank maintains its benchmark interest rate at 2.25%. Welcome to the Economic Bulletin with me, Hala Hamalawi, and we start off with the European Central Bank President Christine Lagarde, who has urged European lawmakers to quickly pass legislation to support the launch of a digital euro. Speaking in the European Parliament, Lagarde reiterated that a digital euro is crucial for Europe's financial independence. She also criticized privately issued digital currencies known as stable coins, explaining that they pose risks for monetary policy and financial stability. Lagarde further pointed out the lack of global regulation for stable coins, noting that Tether, the largest stable coin issuer, operates from El Salvador, a country which lacks any prudential framework for such products. Goldman Sachs CEO David Solomon, who has urged Europe to reconsider its extensive regulatory requirements as they place unnecessary burden on companies. Solomon noted that one of the EU's biggest challenges is that individual countries can veto reforms to protect narrow national interests, a dynamic that he argued has consistently weakened the bloc's economic, financial, and geopolitical power. Solomon further highlighted that member states needed to play their part in building the pools of long-term capital required to channel financing more forcibly into both public and private markets, where he noted much of the economic activity in Europe was then happening. Still in Europe, the Bank of England Deputy Governor Dave Ramsden has stated that Britain's jobs market shows clear signs of weakening, making him more concerned inflation could fall below central bank forecasts. Speaking at the Barclays CEPR Monetary Policy Forum, Ramsden pointed to private sector employee numbers now being in contraction territory. His remarks come after he was one of 3 members of the 9-strong Monetary Policy Committee who voted last week to cut interest rates to 4% from 4.25%, while the majority opted for no change. Ramsden emphasized that even at 4%, borrowing costs could remain clearly in restrictive territory and that the Bank of England must respond to the weaker economic outlook. Data from market researcher Kantar has shown that British grocery price inflation rose to 4.7% for the 4 weeks to June 15, its highest level since February last year, dealing another blow for low-income households. Kantar noted that grocery sales in value terms increased 4.1% year-on-year over the 4 weeks, helped by warm weather. However, it said that when inflation was taken into account, grocery volumes fell 0.4%, the first year-on-year decline this year. Sweden's Ministry of Finance has halted its economic growth forecast for this year to 0.9%, down from a May projection of 1.8%. Minister of Finance Elisabeth Svantesson attributed this reduction to geopolitical uncertainty, including global tariffs, which has made households and businesses hesitant to spend. She also noted that a recent change in GDP measurement methodology led to a historical downward revision of figures, impacting the latest forecast. Despite this, she highlighted that increased public spending, especially on defense, rising real wages and decreasing interest rates, positioned the Swedish economy well for recovery. Moving on to Asia, Japanese Prime Minister Shigeru Ishiba has stated that it was important to build up the necessary defense budget for Japan, while stressing that a numerical target for the budget should not be prioritized.
最初から GDP いくらありきということではございませんが、必要なものを我が国の判断として積み上げていくということが重要だと思っております。その際、同盟国でありますアメリカとの調整を行うということは、それは同盟国であります以上、当然のことであり、意思疎通というものは綿密に図っていかねばならないということだと考えているところでございます。金額ありきではございませんが、必要なものをきちんと積み上げていくということが重要であり、そのためには、国民の皆様方に今の安全保障環境がどうなっているかということをきちんとご説明をして、納税者の方々のご理解、国民の皆様方のご理解を得るために努力をしていくことが必要だと考えている次第でございます。
The International Monetary Fund has announced that Bangladesh will gain immediate access to $1.33 billion. This follows a positive review of the country's performance under 3 IMF facilities, including the Extended Credit Facility, Extended Fund Facility, and the Resilience and Sustainability Facility. The disbursement comes as Bangladesh, which secured a $4.7 billion bailout in 2023, continues to manage macroeconomic pressures like high inflation, low growth, and an external financing gap. The IMF noted that Bangladesh's program performance has been broadly satisfactory. In North America, data has shown that Canada's annual inflation rate held steady at 1.7% in May, unchanged from April, as falling gasoline prices and cooling costs for shelter, food and transportation kept the overall index stable. Despite concerns over U.S. tariffs, headline inflation was contained. The Bank of Canada's key core inflation measures eased to 3%, aligning with the upper end of its target range. This data will be crucial for the Bank of Canada's July 30 rate decision, with markets currently betting on another hold after recent pauses in rate cuts. Meanwhile, in Latin America, Argentina's economy has grown by 5.8% in the first quarter of 2025 compared to the previous year, marking its strongest expansion since 2022 and its second consecutive quarter of year-on-year growth. The official data released on Monday indicates a recovery from last year's recession, despite President Javier Milei's ongoing austerity measures. Private consumption notably increased by 11.6%, while exports rose. A significant surge in imports limited their overall impact. The U.S. consumer confidence unexpectedly deteriorated in June, with households expressing increased worries about business conditions and employment prospects over the next 6 months. The Conference Board reported that its consumer confidence index dropped 5.4 points to 93 this month, revising nearly half of May's sharp gain. This figure significantly missed economist forecasts, who had predicted an increase to 100. Stéphanie Guichard, senior economist at the Conference Board, noted that decline was broad-based, affecting both consumers' assessments of the present situation and their future expectations. U.S. President Donald Trump has said that interest rates in the country should be lowered by at least 2 to 3 percentage points. In a Truth Social post, he highlighted that with no inflation and a strong economy, we should be 2 to 3 points lower, saving the U.S. at least $800 billion annually. Trump added that Powell will be in Congress in order to explain, among other things, why he is refusing to lower the rate. Meanwhile, U.S. Federal Reserve Chair Jerome Powell has stated that the central bank needs more time to see if rising tariffs drive inflation higher before considering the interest rate cuts that President Donald Trump is demanding. During his congressional testimony before the House Financial Services Committee, he noted that increases in tariffs this year are likely to push up prices and weigh on economic activity. Powell further stated that the outcome of that policy shift will be critical for the Fed to understand as they continue to evolve and their effects on the economy remain uncertain. Federal Reserve officials are sending mixed signals on the timing of interest rate cuts, reflecting differing views on economic risks and the impact of trade tariffs. Atlanta Fed President Raphael Bostic sees no immediate need for cuts, citing stable jobs and expected price hikes from tariffs, forecasting only one cut in late 2025. Conversely, Vice Chair Michelle Bowman and Governor Christopher Waller believe that cuts may be fast approaching due to job market risks, with Bowman expecting minimal tariff impact on inflation. Cleveland Fed President Beth Hammack, however, sees no pressing need to cut, seeking more clarity on tariff effects. United States and South Korean trade ministers have reaffirmed their commitment to reaching a deal on tariffs as early as possible. South Korea's Ministry of Trade, Industry and Energy stated that top trade envoy Yoo Han-koo again sought exemptions from President Donald Trump's reciprocal tariffs, as well as tariffs on items such as automobiles and steel. Acting U.S. Ambassador to South Korea, Joseph Yun, also noted at a seminar that there may be new trade talks about the free trade agreement between South Korea and the United States. Goldman Sachs data has revealed that hedge fund leverage hit a 5-year high last week, with speculators buying banks, trading companies, and insurance firms after U.S. interest rates held steady and just before U.S. attacks on Iran's nuclear sites. Gross leverage, a gauge of how much hedge funds are trading, rose to roughly 294%, the most since 2020. Leverage was at 271.8% at the start of the year. And for further analysis, we're now joined from Paris by Mr. Meher Nicholas Frizzley, former World Bank advisor and director of EU ASEAN Center. Welcome to Qnews, sir. Now, we have seen an unexpected drop in U.S. consumer confidence this month. What does this decline tell us about the average American's view of the economy right now?
I'm delighted to join you today.
Always a pleasure.
It's a very complicated issue, and that's why the the vocabulary, the words which Chairman Powell used are very cautious, very cautious. So to make a long story short, in the past 2-3 months, so last time the Fed published detailed macroeconomic data was at the end of March. Today we're at the end of June, so that was 3 months ago, right? A lot of things have happened in the past 3 months. And so now the Fed is looking at the same data, and it seems that the Fed is a little more, just a little more, tiny more cautious or pessimistic than it was 3 months ago. Nothing dramatic or to worry about, but economists always worry anyway. So yes, consumer confidence is sliding a little bit in the US. That's a fact. Everything is relative. First, it is not sliding a lot, it's sliding a little. And then another important factor, it is sliding less than in neighboring countries. So if you look at more broadly, because in economics, nothing is absolute, everything is relative. So if we compare US consumer confidence, let's say, to European consumer confidence, or Asian, or Canadian, or whatever, the US is not bad. In spite of that small decline, the situation is not dramatic, so nothing to worry about. Also, everything is relative. So when people, invest in a country or buy US government bonds or keep their money in US dollars, they're always comparing the risk return profile of their American US assets to what they would get in Berlin, Frankfurt, Paris, Shanghai, etc. So I think Chairman Powell is being cautious, and of course he's under pressure from the White House,
from President Trump.
A little theatrical.
Yes. Well, Fed officials seem also divided on when to cut interest rates. So why are we seeing such differing options within the central bank right now?
Because the Federal Reserve Board is a very strange animal. And we in Asia, Europe, the Middle East have often, and even in America they sometimes have it, we often have the wrong perception. So we think the Federal Reserve Board is a highly centralized Washington, D.C., federal government institution, blah, blah, blah. And it's actually quite wrong. We have to imagine the Fed as a grouping of 6 or 7 regional central banks, right? And it's almost as if in every big region, the Great Lakes, the Deep South, the West Coast, the Rust Belt, every region they can have a different opinion, because sometimes you have regional variations within the US economy, and such a time is now. So right now, we're seeing a relative divergence between different regions of the US. And that's why, for example, in Cleveland or the Midwest, the economy is growing quite well, and things are going quite nice. And if you are a Federal Reserve Board guy from the Midwest or the Great Lakes, you see no reason to lower rates, and you're afraid of inflation more than anything else.
Yes.
So there are internal tensions, and the poor Chairman Powell is simply there to make an arbitrage.
Yes, but at the end of the day, President Donald Trump is pushing hard for rate cuts. How much does this political pressure weigh on the Fed's decisions, especially with Chair Powell testifying this week?
So quite a pressure. There is theater, because President Trump, he loves hyperbole, to use a Greek word. He loves to exaggerate, etc. So we always have to take what he says with caution, because sometimes he speaks more like a second-hand car salesman than the head of the executive branch. But that being said, President Trump is doing his job. So it is his job, in a way, as president, to be a cheerleader for U.S. economic growth, right? So it's his job. He says, we need more growth, we need more jobs, we need to get the engine, right? The engine of the U.S. economy humming strongly. And on the other hand, Chairman Powell has a different job. So he needs to take into account the risk of inflation and monetary debasement. And so they have, they sleep in the same bed, but they make different dreams, right?
Yes, but as is happening now, Chair Powell stated during his congressional testimony before the House Financial Services Committee that the Fed needs more time to assess the impact of tariffs on inflation. What specific economic data are they waiting for before making a move?
Well, that's a problem, is the time frame. So the Federal Reserve Board and any smart economist, for such a big economy as America, you can't update your macroeconomic projections every day or every hour, right? And we live in a short attention span era where people are day trading. They're buying, Nvidia in the morning and gold in the afternoon. And so investors have become very short-termist. And I think it's not really not good at all. And the Fed's role is to keep things normal. So make long-term economic forecast, and they only adjust the forecast every 3 months or every 4 months. And I think it's the right thing to do. When President Trump started what he called, the Liberation Day, early April, started a trade competition or trade war with the rest of the world, of course, it made things more complicated because the White House was sending some aggressive, trade, quote, war signal for 3-4 weeks. Things were very bad. And afterward, Trump maneuvered well, actually. And I think we need to give credit where credit is due. And Trump maneuvered well. And he was able to make things, smoother, etc. Strike a deal with Britain, strike another deal with China. So things are moving forward. And I think that's why, because of the volatility, the anxiety, the volatility. So now consumers are a little bit anxious. Inflation is rising a little bit because of the trade pressure, etc. And I think that's why Chairman Powell is erring on the side of caution, whereas Trump would like him to err on the other side, right? But they have different roles. And I think, in a way, it's partly theater. In a way, I think, I'm giving you a personal opinion, I think it would be a mistake for the White House to put pressure on Chairman Powell and force him to resign and bring on board a more complacent, more submissive chairman of the Reserve Board, because the fact that he has Powell, and publicly they may disagree, I think it's quite good for the US economy to have that visible balance. It gives more, because finance is about credibility. The word credit, credit is based on the same root as credibility. So you can only have a good credit. People can trust buying and selling US government bond if there is credibility. And the presence of Chairman Powell gives Trump credibility, specifically because they don't always agree, right? So I think it's, it's a good couple. The couple is fighting sometimes and bickering, but to the outside world, it looks good to have a second opinion. And I think, that in essence is protecting the US economy, because otherwise, if you listen, if you do verbatim exactly what Trump says, you would replace Powell by a more complacent, lenient chairman, and he would lower rates by 200 basis points, 2%. That's what Trump says he wants. And I think that would be very excessive and exaggerated and not good for the US economy. So I think, to make a long story short, I think things are well the way they are, and Chairman Powell did well not to lower interest rate. One last point quickly, maybe on a political level, and this is the choice of words, right?
Yes.
When he made his testimony, Powell said that, one of the reasons he believed why there was a little bit of risk of inflation and consumer anxiety was because of the trade war.
Yes.
So when he said it's because of the trade war, psychologically, it's as if he was blaming President Trump. So probably President Trump was a little offended by the choice of word, but that is really not very important. At the end of the day, these are small details.
Yes. Well, from Paris, that was Mr. Meher Nicholas Fesley, former World Bank advisor and director of EU ASEAN Center. Thank you so much for your insights. And now we move on to the latest developments from the MENA region. Stay tuned. Morocco's central bank kept its benchmark interest rate unchanged at 2.25%, saying that current borrowing costs align with inflation expectations. In a statement following its quarterly board meeting, Bank Al Maghrib projected average inflation to fall to 1% in 2025 before rising to 1.8% in 2026, largely due to easing food prices. The bank forecasts economic growth of 4.6% in 2025 and 4.4% in 2026, up from 3.8% this year. Foreign currency reserves are expected to reach 407 billion Moroccan dirhams, that is almost $44.7 billion in 2025, enough to cover 5.5 months of imports. The fiscal deficit is seen narrowing to 3.4% of GDP by 2026 from 3.9% in 2024 due to rising tax revenues balancing higher public investment. Oman will impose a 5% income tax on individuals earning over 42,000 Omani riyals annually starting January 1st, 2028. This makes Oman the first Gulf Cooperation Council country to introduce personal income tax. The move aims to diversify government revenue and reduce oil dependence. Officials state the high exemption threshold means roughly 99% of the population will not be affected. The Bank for International Settlements has issued its starkest warning yet on the risks posed by stable coins. It also urged countries to move rapidly towards the tokenization of their currencies. The BIS further stated that stable coins as a form of sound money fall short and without regulation pose a risk to financial stability and monetary sovereignty. In markets, global shares posted a collective gain on Monday. In the U.S., the S&P 500 rose by 0.98%, the Dow Jones hiked 1%, and Nasdaq futures increased by 0.39%. In Europe, UK's FTSE 100 slightly edged up 0.10%. France's CAC 40 gained 1.08%, and Germany's DAX surged 1.59%. Meanwhile, in Asia, Hong Kong's Hang Seng Index surpassed 2.06%. The Shanghai Composite Index jumped by 1.15%, and Japan's Nikkei 225 climbed 1.14%. That brings us to the end of our economic bulletin, and here is what we have been covering. ECB's Christine Lagarde pushes EU lawmakers to pass legislation for a digital euro launch. Trump says that U.S. interest rates should be at least 2 to 3 points lower. And Morocco's central bank maintains its benchmark interest rate at 2.25%. This concludes our economic bulletin. Don't forget to follow Q News on YouTube, Facebook, X, Instagram, and TikTok at Qnews EG to stay informed. I'm Hala Al-Hamalawi. Thank you for watching, and stay tuned for more updates here on Q News.